Welcome to The Explainer. Listen, if you're a busy executive, you're probably pretty disciplined. Every month, you automatically route capital into your savings, right? And hey, it feels responsible. It feels secure. But as we're going to uncover today, there's a massive hidden opportunity cost to relying entirely on a standard savings account. We're going to look at why doing the quote-unquote responsible thing might actually be the very thing holding your wealth back.
Okay, let's just dive right into this. Imagine you've got 10 grand sitting in a standard savings account, and you pop open your banking app and you realize the interest rate is hovering around, maybe 0.5%? That means in an entire year, your $10,000 generated a grand total of $50. $50! It's essentially acting as this bright red, silent thief, literally letting inflation quietly erode your purchasing power, all while you're sitting there thinking your capital is perfectly safe.
Now, when you look at that $50 yield, a thought inevitably creeps into the minds of otherwise rational, highly strategic leaders. You start thinking, wait, am I doing this wrong? Well, the short answer is, no, you're not wrong, but you are incomplete. Look, saving feels like a huge, disciplined win, but mathematically speaking, it's an incomplete wealth-building strategy. Saving is really just step one. So today, we're going to outline the exact operational plan to safely execute step two.
Here is exactly what we're going to cover in this explainer. First, we'll look at the cost of inaction. Second, the volatility trap. Third, we'll lay out a really clear 5-step execution strategy. And finally, navigating market corrections. Let's get right to it.
Section 1. The cost of inaction, or the true opportunity cost of cash.
We need to establish right up front that saving alone is mathematically guaranteed to underperform over the long term. To really understand why, we have to define the completely distinct jobs of saving versus investing. Think about it. As an executive, you wouldn't assign your marketing team to handle your corporate tax filings, would you? Of course not. They're completely different functions. Well, it's the exact same thing with your capital. Saving protects your money. Its one and only job is safety. Investing, on the other hand, grows your money. Its job is building wealth. We've got to stop asking a savings account to do a job it was quite literally never built for.
And the staggering difference those job descriptions make over time is just crystal clear. Take that $10,000 balance again. At a 1% savings rate, it inches up to just over $12,000 after 2 whole decades. But investing that exact same capital at the historical long-term average of the S&P 500, which is roughly 10%, turns it into $67,000. That is the exact same starting capital, separated purely by the job it was assigned to do.
Which brings us to a really foundational truth. The defining difference in financial outcomes isn't just about controlling your spending. Look, both the saver and the investor did the hard part, right? They didn't blow the cash on a depreciating asset. But the real wealth gap, the true divide, is strictly between those who merely save their capital and those who actively put their capital to work.
Section 2. The volatility trap and our behavioral bottlenecks.
You know, there's a deep psychological reason why otherwise totally rational executives hesitate to allocate their capital into the market. Think about a savings balance. It never moves. You check it Monday, you check it Friday, it's the exact same number. To our primitive brains, that stillness feels like safety. But an investment account, that's in constant motion. Up, down, sometimes both before you've even had lunch. Our brains completely misinterpret this totally normal market motion as an immediate flashing red danger. So the volatility itself isn't actually the problem. It's our psychological reaction to it that creates the bottleneck.
All right, moving on to Section 3, the 5-step execution strategy. This is your operational plan.
To make the jump from saver to investor without triggering all that volatility anxiety, the source material gives us a staged, totally delegation-friendly framework. Step 1, build an emergency fund. Step 2, separate your money. Step 3, start small. Step 4, keep it simple. And Step 5, let time work. Let's break these down into some actual actionable directives.
So, steps 1 and 2 are all about pure risk mitigation. Before a single dollar goes into the market, you absolutely need 3 to 6 months of living expenses parked safely in cash. Why? Well, because the #1 reason people panic sell isn't a bad market. Actually, it's needing cash for life's inevitable surprises. A broken boiler, a medical bill. Your cash emergency fund protects your investments from, well, your life. Mentally, you separate this into bucket 1 for safety and bucket 2 for growth. Once you stop expecting bucket 2 to act like bucket 1, the panic just vanishes.
Then we hit Step 3, which is all about momentum. The goal here? Start embarrassingly small just to build the habit. Seriously, you do not need to drop $50,000 on day one. A lot of platforms out there let you enter the market with as little as $50. As executives, you already know the incredible power of standard operating procedures. The habit of investing compounds just as reliably as the money itself.
Which brings us to step 4. The absolutely crucial point here is keeping it simple. Resist the urge to get clever. You don't need to start day trading or chasing the latest wild crypto trend. Take it from Warren Buffett, who famously advises everyday investors to simply put their money into low-cost index funds. Index funds don't force you to pick the one magical winning company. Instead, they buy a tiny slice of hundreds of companies all at once. It automatically spreads your risk and does all the heavy lifting for you.
And finally, step 5, letting time do its thing. Check out this compounding math. It's wild. If you invest $300 a month for 25 years at an 8% return, your total out-of-pocket contribution is $90,000. But your compound growth, that adds an astounding $195,000. So your total balance becomes $285,000. Literally more than double your actual contribution came purely from the compounding machine you set in motion. How great is that?
Section 4. Navigating market corrections, or, as I like to call it, seeds and storms.
Now, as a corporate leader, you already know that external shocks are completely inevitable. So let's look at how to systematically mitigate the risk of market downturns. I want you to think of saving money like keeping seeds in a glass jar. They are perfectly safe, preserved, and they'll be completely unchanged a decade later. Investing, though, is like actually taking those seeds and planting them in the dirt. Yes, it's messy, yes, it's exposed to the elements and the weather, but giving it time in that messy environment is literally the only way it grows into something the jar could never, ever produce. You have to reframe market exposure from a catastrophe waiting to happen into a totally necessary growth environment.
But what happens when a storm actually hits? Because markets do crash. It is a historical certainty. But here is the brilliant business logic the source material suggests adopting. A market downturn doesn't just threaten your money, it actually puts it on sale. You've got to view downturns not as these terrifying panic events, but as discounted acquisition opportunities.
And this is exactly where the strategy of dollar cost averaging absolutely shines during a storm. If you keep your allocation steady, say, continuing that same $300 a month, when the market inevitably drops, your fixed dollar amount automatically buys more shares of equity at a massive discount. Those lower prices are setting up exponentially stronger returns when the market recovers. The most successful investors in the world aren't dodging storms. They're thinking in decades, not in daily headlines.
So, to bring this all together, saving gives you stability. Investing gives you freedom. The absolute beauty of this operational plan is that you don't have to choose between the two. You don't. You simply have to execute them in the correct order. You build the stability first to protect your downside, and then you systematically deploy your capital to capture your freedom.
Which brings us to our final, maybe slightly uncomfortable question for you to ponder today. I want you to take a hard look at your personal balance sheet and ask yourself honestly, are you still just saving or are you truly investing? Thank you so much for joining me for this explainer. Go out there and put your capital to work.